losses have actually gone up quite a bit. 550 crores of loss. Just want to mention that will be in focus as well.
Absolutely, and I think we'll have more details on this one. Paytm, of course, at about 350. The first rates are on your screen. You've got the Nifty, which is starting at about 22,550. So it's a quiet start, as the Gift Nifty indicated at 8 o'clock in the morning. 25 points higher, so very quiet. The Nifty Bank is, I think, lagging a little bit like it was yesterday, the day before. 20 points down there, 48,000, just about holding that level. The mid-cap index is up about 1/3%. I think they've got the small-cap index, which also is not doing very much, about 1/3% higher. It's been about stocks all the way, so let's take it to Sonia, who's got that list. Sonia.
Well, thanks a lot for that. So it's a decent opening for the market, as you pointed out. So up almost about 25 odd points right now. ONGC is really the one that I'm looking at this morning, considering the kind of up move that ONGC is expected to see. Remember, it's had a big rally this year. It's up almost 35% this year. And Nomura has upgraded ONGC to a neutral, raised the target price to 290 on the stock from 150 earlier. So this is one stock that's climbing up. In terms of result reactions, I want to look at Viatec Vabag. The stock is down about 1%, but it is in this water treatment space, which has been buzzing quite a bit. The stock is up 60% this year already, and it's guiding for 15 to 20% compounded growth rate over the next 3 to 5 years. In fact, 62% gains in the past 6 months alone. So a little bit of profit taking is what you're seeing there. Apollo Tyres is the other one. In pre-opening, it was up almost 4%. Sources indicating that Warburg Pincus will be selling its stake in Apollo Tyres, up 5% right now. So keep an eye out on this name. BHEL, the earnings missed estimates, but the commentary was strong. But the street is giving it a thumbs down. The stock is down almost about 5.5%. Metropolis, Amira Shah will be stepping down as a managing director, will become the executive chairperson. But the street likes the numbers. So Metropolis is up almost about 1.5% right now. PI Industries, it's actually zooming right now. Revenue growth has slowed down to 11% year on year. The EBITDA, though, is quite strong, up almost about 29%. Hitachi Energy is the other one that I want to look at. Big moves coming in 6% higher. Strong earnings, revenue growth of 27%, solid order execution. So this is one stock that's looking pretty good this morning. JK Tyres, it has been a mixed bag, but the fact that the company, Dr. Raghupati Singhania, came out here and spoke to CNBC-TV18 saying that things are improving, especially on the export front, and they are looking to outperform the industry. The street likes that. 9.5% higher now on JK Tyres. The margin growth was also very strong, by the way. 280 basis points year-on-year growth in the margins at 13.5%. I'm also looking at two companies that will be reporting their numbers today. There's Sun Pharma and Nykaa. Sun Pharma is down about 0.5%. Nykaa will be reporting its numbers later in the day as well. And just a quick look at Paytm, because the numbers came out just a while back. Losses have piled up for Paytm. It has been going through problems of its own, but the stock is down about 0.5% right now. But for the market, not bad actually, after the kind of stability that we saw in the last couple of days. Nifty hanging on to 22,530. The advanced decline ratio is positive, which is a good thing, but lots of individual stocks in focus. Nigel, back to you.
All right, thanks a lot for that, Sonia. Well, let's focus on a couple of big movers today. Hitachi Energy, well, yeah, that's the result of the day, actually. The stock is still holding with a gain of close to around 6%. So big move is what you're seeing out there. Hindustan Zinc, the stock has more than doubled, in the last 45 days or so. And we had highlighted this early in April when the stock was at around 330 rupees. So if you're enjoying the ride, good on you. But just one word of caution out there, that the free float in the market is less than 2%. So, you could get whipsawed on either which side. For the time being, it's on the upside. So if you're enjoying the ride, then good on you. But keep that word of caution in mind. Gulf Oil Lubricants, that's one of the top winners in today's trading session. The stock is up close to 7%, so keep an eye out on that one. IRDA, on the back of high volumes, that stock as well is up close to around 2%. So that one comes on your radar. Another big volume mover today is Easy Trip. So all those stocks on your radar on the upside. On the flip side, GSFC, the stock is down more than 5%, so that's getting clobbered in trade today. Tilaknagar Industries, so that's another stock I think that's reacting to its number, so that one as well is getting smacked, down more than 5%. Maharashtra Seamless, well, we'll have the management in just a bit to talk to us about why the operational performance was weaker. Q3 was a high base, but that stock as well is down close to around 5%. And Global Health is the last one that's trading in the red. So quite a few of these names, moving in either which direction. Let's get a few of them up for you on the screen. Global Health as well as Maharashtra Seamless. We'll get the management in a few minutes from now. Prashant.
Well, it's a kind of a holding pattern, right? And this is what we were talking about. So not really taking a big bet, being sort of building in a fair bit of caution right now. The PSU space continues to buzz, and we were talking about this right before open. So RVNL The biggest volume-led gainers are all these names. RVNL is up 3.5%, NHPC is up 4%, IRIDA is up 4%, SJVN is up 3%, RailTel is up 4%. This is the top volume-led gainers list across on the NSE. Oh boy, Hindustan Zinc, 20%. I think Nigel mentioned that 20% yesterday, 8% this morning. That is, if there ever was a definition of a supersonic rocket, that is it. And what an absolute stunner of a move coming through. And by the way, this year, and we're still not sort of halfway through into 2024, stocks up 150%. So that is the extent of the move in this name. Float, of course, is, we've always highlighted, is low, very, very low for Hindustan Zinc, free float. What else? Adani Power is up about 3.5%. Big volumes as well at this point in the day. Action Construction comes up with a 3% pop. Metropolis, I think we did mention earlier here, 6% higher. And, D-Mart is up about 3.5% as well. Market breadth is pretty solid. It's about 2.5:1 in favor of what's up. BHEL remains the top volume-led loser right now. It's down 4%. Of course, stock's done very well. Numbers disappointed, although the management commentary was good, but the market is paying attention to the numbers at this stage, at least, right at the word go. What else? IEX is down about 2.5%, and there is a few other stuff. I think Brigade Enterprises down 2%. Medanta is a disappointment. Numbers disappointed for the Lucknow hospital. So the overall numbers were a little subdued. Was down yesterday, and I think it's down another 5% this morning. That's a large hospital company.
I just want to mention one stock, Dixon Tech. Of course, we've talked about that ad nauseum, and we spoke about it on the Editors Roundtable show as well. Last week, it's a fresh high, by the way, for Dixon Tech, and piling on the gains. Last week, the company told us that from 7 million displays for mobile phones that they're manufacturing currently, they're going to head to about 30 million by the end of FY25. That's been their guidance all along, but that's a 4-time jump that they're expecting to see this year. So the street is definitely liking that quite a bit. And, a couple of other stocks. I mean, there are a lot of stocks that are hitting fresh highs. IRCTC is another one that's been hitting fresh highs. And the stock IRCTC is now up almost 30% this year. Been a big mover. So many of these names, Dixon Tech, Avenue Supermarts, BEML, all the earlier erstwhile favorites are now coming back into the market.
Absolutely. And, this is a good-looking screen. I mean, if you assess the market and judge the market by stocks, it's not bad at all. If you want to look at the index, then you'd probably sort of give it a big yawn and say, well, not very much is happening. It's just about 5-6 odd point change. But I think that would be the wrong way to look at things because, after all, it's all about specific names here which are in focus. We have Ramesh Mantri, who is with us, Director of Investments at White Oak Capital. He's coming on for the first time on this slot. Ramesh, it's good to see you. Good morning, Prashant this side. Thanks for joining us here on CNBC-TV18. Ramesh, so how are you and your team thinking about this? Clearly, we're in a bit of a wait-and-watch mode. It's a big event. It'll come and go, but nevertheless, you've got to sort of cross that, right? Which is the election result. How are you guys thinking about this one, going into it and out of it? Let's start there.
See, first of all, we are no election specialist or political specialist to have a very strong view on what happens. We are just going with the broader consensus view that, whatever the general market belief is, what is going to play out. And hence, we are fully invested as we go into the election results. So our view is don't change anything, wait for the election results, and then take a fresh view of the situation.
Ramesh, is the market itself looking pretty all right? I mean, this entire election thing hanging in the near future. I mean, otherwise things are looking good. I mean, actually, global markets have been pretty good. There is the promise of a rate cut, easing cycle, which will begin at some point. So it's a pretty constructive environment overall, isn't it?
Yes, so I would say it's a mixed picture. Things are improving, markets are rallying. At the same time, you continue to see sometimes surprises on inflation, sometimes on geopolitics, right? So, I think the India picture is a lot more sorted than globally. I think India, the earnings season has been slightly weak this time, but this is more because government spending has been weak going into the elections. And hopefully post the 4th June, that spending pipeline will open up. So otherwise, the domestic picture is a lot more, clearer than the global picture.
Okay, domestic picture is a lot more clearer than the global picture. For now, at least, you have the mid-cap end of trade, which is looking very good. So broader market traction is picking up. Ramesh, hi, good morning. Good to see you in. Tell us about your new special opportunities fund. What does it entail? What are you guys looking at?
Yeah, so the whole idea of the special opportunities product is to, take a, look at all the special situations that emerge in the Indian market, and also to take a slightly contra view to our general style of investing. So this is going to be more opportunistic because you are going to be contrarian in many of the positions. It's going to be more value oriented than our typical style is. So this is going to be a product with slightly higher volatility, but hopefully it will perform differently from our other products, and hopefully will deliver better returns over the long term.
Interesting one, Ramesh. Good morning and good to see you on the show. Nigel on this side. You want to give us a sneak peek? What all could feature in that list? You have a couple of banking names that have underperformed. You have some FMCG names that have underperformed. I don't know. There's a long list out there. And there are big outperformers as well. But since it's a contra fund, you want to give us some kind of a sneak peek?
Yeah. So interestingly, this fund is getting invested on 4th June after the election results are out. So we have, the allotment date is actually 4th June. So it's been properly timed because the election is a special situation in India every 5 years, right? So that's the context. So because it's a special situation fund, I wouldn't talk about any positions as of now because first we have to wait for 4th of June because that itself will determine the path in many ways for special situations in India.
Okay. All right. Ramesh, since we're talking about the elections, you think the markets will be okay? 272 plus, that's done. Or maybe the expectations were elevated, 400, 350 odd. If it's closer to 300, is it par for the course, or do you think the markets will be disappointed, which gives you a good entry opportunity actually?
See, honestly, after you get a clean majority, incremental seats don't add up much. Even this is all talk and all, but once you have a majority government, it doesn't matter whether you are 270, 300, or 330. It doesn't matter unless you get to a 400 number, which means you have ability to change laws, change constitution, which is a different set of powers. So I don't think the discussion between 270 or 330 matters a lot. And even matter, in fact, between even 250 to 330, it doesn't matter, because the government will be formed.
Okay. In terms of sectors, right, where do your preferences lie now? You said that the domestic picture is a lot more clearer than the global picture. So I'm guessing you're looking at domestic facing, infrastructure, manufacturing, etc. But just take us through where do the big opportunities lie, both in terms of growth as well as in terms of valuations?
So these are very different answers, actually. Only a few pockets are there where you actually have very interesting mix of growth and valuation. I would say the banking and the BFSI space has been beaten down. It's been actually the only large sector I can think of which is trading below long-term valuations and where fundamentals are still very good. Growth is good. So that's the only basket where valuations and fundamentals are very strongly aligned. And you can't have economy growing rapidly without the large financial sector participating because somebody needs to fund the growth, right? And of course, intermediate savings to the entrepreneurs. Coming to growth, I think there are some very strong growth pockets in India starting with, let's say, the manufacturing story, electronics manufacturing. I think there's just a story today that the Google Pixel phone is going to get manufactured by an Indian EMS company. You have power capex cycle is going to be massive, particularly on the renewable side. Infra story continues. And then, of course, there are going to be pockets, sub-segments within markets which are doing well. By the way, capital market businesses are doing exceedingly well as we speak. So the growth is, and I'm sorry, I forgot to call out real estate. I think real estate remains, the underlying fundamentals remain very strong and continue to remain very strong. It has come after many years, the cycle has come back. So overall, the economic momentum is broad-based. The only space where we have seen weakness, one is FMCG, where now people are expecting some green shoots. And consumer discretionary, the urban consumer discretionary is still quite weak. Apparel, shoes, a lot of sectors in that. Our retailing is quite weak as we speak. But otherwise, that, the spaces where government has a lot of focus, which is, manufacturing, EMS, defense, those are doing well. And most companies in that sector have surprised markets, and the stocks are done exceedingly.
Ramesh, but if you are already in and you're enjoying the ride, that's great. But valuation is a problem. I mean, for these names, the EMS space.
Yes, so clearly, the ask rate is clearly going up. So you're very measured. I think now, it's going to be a lot more bottoms. So even by the way, within the EMS space, we have seen a couple of companies execute very well, and a couple of companies have disappointed significantly in electronics manufacturing services.
Yeah.
Right. So it's again a bottoms-up story rather than a top-down story. I think valuations generally in India, wherever there's very high growth, are always high. India has always been a growth market, and the market is clearly bid up. Valuations in small cap are at uncomfortable levels very clearly at a broad-based level. Within that, there are opportunities. I think the real value bucket in the market is actually more today on the large cap side rather than on the small cap side.
Okay, so just one more question before we let you go. Since you were talking about, a couple of sectors, right? I wanted your thoughts particularly on autos, because we're seeing now a revival, not just in the sector, but in the ancillary space as well, especially the guys who have a big exposure to the electric vehicle space, given EV adoption. But the only problem here is that growth rates are not picking up as fast as one would have expected. I mean, the management of JK Tyres was just telling us that the entire tyre industry will barely grow 6 to 8% in FY25. Would that deter you a little bit, or do you think that this is a good space to get into?
So auto demand is coming up. You see, over the last 5-7 years, the cost of auto ownership had gone up a lot because of, higher road taxes, insurance costs had gone up significantly, particularly the cost for two-wheelers had gone up significantly. And surprisingly, in India, the entry-level car market is not doing well, and SUV segment is doing very well. So there's a dichotomy in the premium segments across categories are doing well versus the mass segments. So auto demand is clearly seeing a revival, and we are started seeing benefits in ancillary also. And a number of companies are actually the export stories also. Remember, auto components is the original export story, manufacturing story, right? Apart from pharma. If you go back to the previous decade or so, apart from pharma, auto ancillary, auto components are the companies that started exporting. It's a large market to go. Coming to EVs, I think the adoption is slower than we think we anticipate it to be. And in fact, people now believe that EV adoption will take much longer than we had anticipated. And we might not end up, it is not so clear-cut that the end game in every auto market is the EV. You might end up having multiple fuel models, coexist. And people are talking about, even vehicles based on hydrogen. In India, hybrids are a good intermediate solution, because you get a lot of benefit on fuel efficiency. And remember, transporting, the charging infrastructure is a very necessary condition for EV adoption. And that rollout is still very slow on charging. And then, by the way, that is a public good. And, it is an infrastructure that has to be provided by the authorities on charging infrastructure.
All right. Ramesh, we'll leave it there. Thank you very much for your time, and we wish you all the best with that fund. And, once you kind of have those investments in, maybe we can talk about a few names. But that, as you said, is only going to happen post-elections, post the numbers come in. That's the timeline for that one. Well, let's focus on our first corporate after market open. RateGain Travel is the company that we're focusing on. Strong performance in the fourth quarter, great numbers for FY24 over 23. They're guiding for about a 20% organic growth in FY25 as well. We have Bhanu Chopra, Chairman and Managing Director at RateGain, who's joining us now. Bhanu, good morning. Great to have you with us here on the program. Thanks very much for your time. Prashant this side. I want to just talk about that guidance that you put out. 20% organic growth in FY25. But I think there is an inorganic opportunity as well around the corner. So I want to start with that. So what is the inorganic growth going to look like? Total growth going to look like?
So good morning, Prashant. So as you're already aware, we are acquisitive company and M&A is a big part of our strategy. Over the last sort of 12 months, we've actually made out offers to 12 companies, and unfortunately, there has been a valuation mismatch as a result of which we haven't been able to consummate anything. And as you know, we are fiscally very, very disciplined in what we pay. So what we usually do is look at the company and see what it's gonna look like in our hands. So we build out our own internal models and look for an IR north of 20% and a payback of sort of 5 to 7 years. So given that, we've been quite disciplined on what we are willing to pay, and I'm hoping something will fructify in the next quarter or two. So yeah, we are very close, and we're looking at opportunities in DAS, MarTech, and distribution, which are the three business lines that we have.
Banu, that's 12 companies you made an offer, but valuations are not matching, right? So you got to be, you got about 1,100 crores of cash on the book. So you're ready. Just give us a sense. You gave us some criteria about IR and payback, etc. What geography? What's the typical sort of sweet spot in terms of a deal size? And you'll have some sense of what the total growth could look like post this acquisition, because it looks like it will happen this quarter or the next quarter. Go on.
So, in terms of our sweet spot, we've, in terms of what we pay is about 20 million, but those are the kind of deals that we've done in the past. But looking at all the deals that we are looking at, they're actually, in different revenue ranges. Some are even very, very transformative. So it's hard to, commit to something at this point. As soon as we are closer, I'll come back on your channel and talk more about it.
But it looks like it's more than 20 million, what you're looking at this time. It's a bigger one.
You're very good, Prashant, at getting something out of me. But I'll stay firm and say we'll come back and talk about it, once we are closer.
Okay. What was the organic growth that you saw in FY24?
So we were north of 30%. And as you saw in the last quarter, that's completely organic. We did 40%.
So you're saying north of 30% in all of FY24, and you have guided for a 20% growth in FY25, correct? Just trying to get that number out of the way.
That's correct.
Okay. And on the margin front, there was a sharp jump that you saw quarter on quarter and year on year. Can you tell us what are the margin levers that you have in FY25, and how will you achieve your margin guidance of 100 to 200 basis points expansion in FY25?
So as you know, Sonia, the SaaS model is a very superior business model, and the operating leverage begins to kick in. We are operating at gross margins of north of 75%. So as we add more revenue, a lot of that flows down to our bottom line. So basically, as we scale, we should continue to see operating leverage, and we should continue to see the operating margin go up. In fact, a lot of our mature products, are north of 30%. I usually categorize our investments into sort of three buckets. I call it babies, teenagers, and adults. Adults are like our cash cows, which I said are 30%. Teenagers are like sort of products which are breaking even, have had some scale, but are at a tipping point to really scale up. And babies are investments, so we continue to produce a tech company. We continue to produce babies, and we invest in new products that we see have an opportunity within our customer base. And so on a blended basis, that's how we arrive at 20%. But at scale, I'm pretty confident that we'd be operating at a much, much higher margins, more equivalent to where our adult products are, which is, north of 30%.
Hi, Banu. Good morning and good to see you. And I recall when you were talking to us about inorganic growth a few quarters ago, you were talking about marriage and how, things shape up post-marriage. Now you're talking about babies and how, you nurture them as well. So interesting times out there. Banu, a couple of questions on this top-line growth that you're guiding for. 20%, are you being a little bit conservative? I recall last year you had guided for a number, and by the end of it, you achieved way more than that. Now you have that inorganic growth as well that's in your fold. So do you think you're being conservative on this 20%, and there's a probability that you increase it as the year progresses? That's point number one. And point number two is, you've been talking about doubling your revenues on FY24 base. So you'll be a 2,000 crore company by FY26-27?
That is correct. So in terms of addressing your first question on being conservative, so look, if you look at last year, we guided for 55 to 57% on top line growth, and we ended at 69% for the year. We guided for 17 to 18% EBITDA margin. We ended at 20%. So if you want to pick cues from that and call me conservative, I'll let you decide that. But we, want to continue to build the trust of the market and, continue to over deliver. In terms of inorganic growth, like I said, we're hard at it, but at the same time, we want to make sure that we make prudent decisions, because I believe the company has a huge potential in front of us. Ultimately, it's a marathon, and we want to build this into $1 billion revenue company. So, but we want to continue to take the right steps and be very, very prudent about what steps we do.
All right. So that 20%, there's a possibility that you upscale that, right?
Yeah, I'll continue to reinforce. We will, we're guiding for 20%, but
okay.
Yeah, I'm fairly confident that we will consummate something here, and as soon as we do, that should our growth profile as well.
All right, Banu, I was just looking at your verticals, and the distribution business revenue growth, that grew a little bit slower than the other models, Martech as well as Tyres. When does it start growing in line?
So, as I've said in the earnings calls also, our business on distribution is a bit lumpy. We have, won some very, very large orders, and it took us a little while to monetize those. So the growth profile on our distribution business this year, again, should be more around the blended growth number of 20%, because we are seeing those big orders have been now monetized, and you will begin to see those numbers, play out in subsequent quarters.
Okay, I also wanted to talk about this slowdown that many IT services companies are talking about in terms of deal conversions. Are you seeing a slowdown, a deferral of deal conversions? You've actually had new contract wins which have more than doubled in FY24. How does this set you up for growth in FY25, and how are deal conversions looking now?
So in terms of deal conversions, we haven't seen any slowdown. As we focus on travel and hospitality, and our customers are doing extremely well. The attrition rates are very, very high in our industry, and as a result of which the industry has now more money because they're doing really well, and they want to move towards digitization and tech, and we are big beneficiaries of that. So as you saw in our numbers as well, we've doubled our contract wins, and we continue to see some very, very good traction this quarter as well. So nothing yet.
Banu, on margins, you're guiding for between 100 to 200 basis point improvement in margins, right? For F5, that's a pretty wide range. Could you talk to us about, and what are the drivers here? What's the dominant driver in that sense?
So as I mentioned, Prashant, we are at a 75% gross margin. So additional revenue largely flows to our EBITDA. Our big investment is into now sales and marketing, and we are expanding our sales and marketing teams. So as the company continues to scale up, given the high margin profile, given the SaaS business model, we will continue to see acceleration in our margin profile as well. But I do believe that there is a lot of, potential for growth. So we continue to invest in our sales and marketing capabilities, getting deeper in certain geographies. And as a result of which, we want to be conservative in how we expand on these margins as well.
All right, final question, Banu, before we let you go. North America contributes, I think, 50-55% of revenues. There was a degrowth on a sequential basis out there. Why is that?
So one of our business lines, which is MarTech, it's sort of seasonal in nature, especially around the acquisition that we did in Adara. So what you will find is Q1 is usually stronger than Q4, and Q3 is stronger than Q2. So it was a result of that seasonality that we saw some weakness.
Okay. Since you spoke about Adara, how high are the M&A valuations now versus what you paid for Adara? If you can just give us a sense.
Well, the market has been pretty buoyant, and given the interest rates are sustaining at the levels that they are sustaining, I do believe that there will be a little bit of a letdown on the ask by some of our target companies, and that's why we are holding steady on the kind of valuations that we are willing to pay. So we are very clear on what we would pay, and we want to achieve the IRR and the payback thresholds that we have. So we'll continue to remain quite disciplined about the kind of deals that we do.
Okay, all right. Banu, thanks a lot for joining in. We look forward to more marriages, bringing up of those babies and, growing the company towards that 2,000 crore and then $1 billion of revenues. Appreciate you joining in and speaking to us here on CNBC TV18. For the time being, though, we'll slip in a short break. On the other side, we'll shift focus to Maharashtra Seamless to talk about the past quarter's numbers and the way ahead. Later on, we'll also be joined by the management of Hitachi Energy. Stay with us. Welcome back. Well, let's focus on another management. Maharashtra Seamless, the numbers looked a little bit weakish. Quarter 3 was a stellar set of numbers, so maybe that's what's playing on these results as well, because relatively these numbers were much weaker. The stock, however, has corrected more than 20% from the recent peak, telling you that the street was bracing for a rather weak set of numbers. Mr. Kaushal Bengani, the Deputy General Manager, joins us on the show. Hi, Kaushal. Good morning, and thanks a lot for joining in. Well, for the markets, we track two basic numbers. One is on the volume front and one is on the EBITDA per ton front. Could you tell us for both the verticals, what kind of volume growth are you looking at on the ERW as well as in the Seamless division? And what's the steady state EBITDA per ton we should look at? Because in this past quarter, this Seamless number did come down quite a lot.
Yes. Thank you for having me. In the fourth quarter, we had dispatches of close to 95,000 tons, and that is lower than what was there in the previous quarter of this year and also the quarter of FY23, last quarter of FY23. The primary reason why that happened in this particular quarter was because of mismatch in the product mix that we have. We had certain large size orders which were expected to be dispatched in this quarter, but that did not take place. Going forward, we expect that to normalize because we recently received a large order from ONGC of 674 crores and our order book remains good. Right now, our order book is 60% ONGC and Oil India, and generally these are good margin orders for us.
Okay. All right, Kaushal, so we got that. There was a dispatch that got pushed forward, which in turn resulted in a weakish showing in Q4. But let's talk about FY25 then. For your Seamless division, last year, I think you did roughly around 400,000. For this year, what can you do on volumes? And on ERW as well, it was around 100,000. So on both these two, what can you do, given that your order book is looking quite good at around that 1,700-1,800 crores?
In FY25, we'll probably do same levels for ERW, which is around 100,000 tons, maybe 5% growth, because we've recently been able to ramp up production on the ERW front. On the Seamless front, we've not been able to ramp up production immediately because there is a finishing line which we are trying to implement at our Telangana unit. Once that is in place, we will immediately see volume growth in the quarter in which it is implemented. As of now, we expect that to take place in the fourth quarter of FY25. But
please go ahead.
Okay. So on the volume growth front, I don't believe we'll have volume growth significantly in FY25, but definitely in FY26, because in FY25, we will be taking shutdown in one of our mills for preventive maintenance. That will have an impact on the quantity produced and dispatched,
so for
which may be negated.
Sure. For FY26, any indication of what the volume growth could resume to?
So FY26, once we have that finishing line in place, we'll have volume growth of at least 70 to 80,000 tons, because right now we are not utilizing that capacity fully on account of that bottleneck.
Okay. And out of your total order book, ONGC and Oil India is about 60% of the mix. So does this mean higher margins for you? Does this lead to higher margins?
Generally speaking, that is true. So we expect that to fructify in FY25.
Yeah. So what does that mean? I mean, if you have higher margins, right, coming in and you're expecting it to fructify from FY25, on the EBITDA per ton for both the segments, Seamless and ERW, what would a sustainable level be?
We wouldn't like to give you a number, but just to give you an estimate of what the range would be, in Q3, we did 30,000 rupees per ton on the Seamless front. And in Q4, we have done 21,000 rupees per ton. We expect margins to remain upwards of 15,000 rupees per ton going forward.
For Seamless,
for Seamless, which does not necessarily mean that there will be a decline, but because we have short cycle order books of 3 to 4 months, we are not able to comment on margins beyond that because I don't have that data with me.
And for ERW?
ERW would generally remain between 6,000 to 11,000 rupees per ton, because the ERW segment is a mix of two sub-segments in which pipes are dispatched. There's an oil segment and there's a water segment. Depending on the margins that are generated in the oil segment and the water segment, the blended margin is received. So oil sector orders are more margin accretive than water sector orders.
All right, but Kaushal, need to push you on this Seamless guidance that you're giving us, more than 15,000. That will be very disappointing. Last entire year, you did 20 to 30,000 rupees. Why are you talking about this 15,000 rupees? Or is it just a base case scenario and it's likely to hover in that 20,000 odd range?
We are talking about a base case scenario because what we have seen is margins have continually gone up over the past 2 years from 12,000 rupees a ton to 31,000 rupees a ton. So because I don't have data for the rest of the year and we operate on a short cycle order book position, we would not want to give guidance more than 15,000 rupees per ton, because that's the base case that we want to work upon.
Got it. Okay, rigs is a small part of your business. The EBITDA last year was around 50 crores, but there has been some repricing of rigs. So will it contribute much more for this year, or should we be working with a number closer to what you've done in the past? And also, since things are looking up, any plans of selling this rigs business?
Yes, on both the points, the rigs was repriced in May 2022. Unfortunately, the tender for the rig was submitted prior to the Russia-Ukraine war, which meant that the effect of the repricing was just missed. Because immediately after the Russia-Ukraine war in February 22, when new tenders were released, they went up as high as 80,000 rupees per day. on the rig rental front. However, since the tender we had submitted was prior to the Russia-Ukraine war, when the rig was redeployed on a new contract in May 22, it was at 38,000 rupees per ton. EBITDA of 50 crores is what you should be projecting going forward, because it's a 3-year contract which will conclude in May 2025.
Oh, okay. And any plans of selling it?
We do have a thought of taking the rig out from Maharashtra Seamless, but that is subject to board approval. So we've not yet started working upon it, but it's a thought which has been constantly been communicated to shareholders, and towards the end of the contract, we'll be looking at it.
Okay, all right. We will leave it at that. Thank you so much for joining in. We got lots of information from you. All the best for the quarter to come. That's Maharashtra Seamless. Their margins have expanded this time around, and but the stock, by the way, is under pressure, down almost 5.5%. But let's focus on Hitachi Energy India now. The stock is reacting to its very strong performance in Q4. Revenues saw a good growth, margins have expanded, order inflows have surged. N. Venu, who is the Managing Director and CEO of Hitachi India, joins us now to talk about that. Mr. Venu, thank you so much for joining in, and congratulations on a good set of numbers. I want to start with the margins, because you had guided that you will reach double-digit margins in FY25, but you've achieved that in FY24 itself. Can you tell us, with metal prices moving higher, will you be able to sustain margins at these levels? And if yes, do you have any more levers to, grow your margins further in FY25?
No, thank you very much for having you in your show, and good morning to everyone. As you have rightly said, the Q4 was a strong quarter. Our revenue, orders, and everything has really grown double digits, and that has, with the high revenue growth, has also helped our margin accretion and margin expansion. And our business is what we call as a both long cycle as well as a late cycle business. And while quarter on quarter comparison is absolutely okay, but we always look at midterm to long term view on that. If you really look at the whole of FY23 financial year, our EBITDA margin was 6.7%, and we have improved 100 basis points compared to the previous financial year in that. So the direction is that to improve the margins sustainably, 10% EBITDA level is what we are looking at it in that. So our guidance has been that we enter double-digit margin by end of FY25 is what we are looking at it. And we need to do a lot, and we're going to do that both in terms of our base orders, in terms of our service, and in terms of our exports. So these are the levers we are looking at it. I fully agree with you that the metal prices are going up. So we are taking all the necessary actions to see that our portfolio is shielded from that. We have a very strong order backlog of more than 7,200 crores, and that give a very good visibility of revenue and also margin out of that in the coming quarters.
So will you be taking any price hikes in order to push the higher metal prices to consumers? Is demand strong enough for you to pass on prices?
We will definitely, case to case basis. We have been very actively and transparently. We are working with our customers, and then we wherever we need to push it, we will be able to give this price increase to our customers. But bulk of our portfolio, what we have is also variable prices, so that way it will be shielded to some extent at least.
Okay, so there's this continuous kind of rolling price hikes, which you pass on. So it's variable contracts, not fixed price, right? Mr. Venu, hi, morning, Prashant here.
Hi, morning, Prashant.
So the segments you operate in, the demand, of course, looks very, very strong. And investors have noticed that your share price done very well, but others in the sector has also done very well. Now, could you talk to us a little bit about the opportunity size on the domestic transmission capex? The size as you see it, and how will this, some materialization timelines in that sense? When will this opportunity materialize into specific orders? If you can give us a sense.
So I'll come to your exact question to answer your question. But before that, if you really look at our last year, we had a highest base order growth. If you take out our HVDC, so we had a double-digit order growth. And this growth is across the segment. The energy transition is now a broad base. It's not only utilities, transmission, renewables, but also industry, exports. So that way, we don't have any lumpy, orders in the last years in there. So that's a very good sign for our, from orders to revenue conversions in that. So coming back to your question on that, Prashant, is that, if I take only one segment, that is interstate transmission, which government has set itself ambition of 500 gigawatt of transmission, which will give you approximately 2.4 lakh crore, which is the is the estimate from the budget from the government start 2.4 lakh crore of the investments in that, right? So our addressable market in that is approximately anywhere between 40%, 35 to 40% in that, depending upon what kind of projects, HVDC, STATCOMs, transformers, etc. in that. And the timeline, as you know that this is a lot of acceleration is happening in that. Bulk of this ordering, in our view, will happen in the next 2 years' time in that. Of course, there also will be some tailwinds going forward to the third, fourth year. But if you really want to reach the 2030 target, our view is that bulk of the ordering should happen in the next 2 years or so.
Okay.
So that's quite substantial order flows we expect.
Right. Okay. Could you so you operate? So you said the interstate transmission market about 2.4 lakh crores.
Yeah.
You operate in within 35 to 40% of that of the value chain, about 1 lakh, about a lakh odd crores, right?
Right. Exactly.
And you're saying that ordering will happen, bulk of it will happen in the next 2 years or so.
Right. If you really want to reach the target of 2030 target, so the bulk of ordering should happen in the next 2 years, or some of them can spill over to third year.
Could you give us a sense of what kind of numbers you're getting? I mean, you're in obviously constant touch with people on the other side of the table, like, your counterparty in that sense. Could you give us a specific, not exact numbers, but in the ballpark, what should we expect over the next 2 years in this space?
Right. I know, you know, Prashant, very well. We don't give any forward-looking statements on that. But about all I can tell you that, in anticipation of the demand tailwinds, especially driven by the energy transition, we have taken a lot of actions in ramping up our expansions, ramping up, building up the new factories. For example, we have opened a year before, Greenfield HVDC factory in Chennai, and we opened another Greenfield factory in Bangalore for the power quality. So all these things would help us in a better position to take our decent market share in those orders, and that's where we are getting up. And in our view is that, as I said in this channel, and I continue to repeat for the sake of repeat, if the market is growing X, we want to grow higher than the market because we have taken a lot of actions and we have a full portfolio. And we also said 85% of what we produce globally, we also manufacture locally in our 19 manufacturing factories. And that would be a big support for our customers in ensuring that we supply in an uninterrupted way on this very important energy transition related portfolio.
All right. Hi, Mr. Venu. Nigel on this side, and good to see you. When I recall in September 2023, I kept pushing you whether you will get to the double-digit margins by the end of the fiscal, but you said no, it'll be FY25. So it's good to see actually that you've gone ahead and achieved that target earlier than expected. Good on you. Now, in this conversation itself, you have mentioned HVDC numerous times. And the high voltage transmission, I think there are only two players in India, if my understanding is correct. One is Hitachi, which is you, and the other one is Siemens. Is that correct, sir? Only two key players that are equipped for HVDC orders?
No, there are globally 3 players out there. So,
but in India?
Yeah. I think India also three players, at least 3 players.
All right. So that will be Hitachi, Siemens
and GE.
And GE. Okay. So 3 players are there, but I think the 2 larger players are yourself as well as Siemens. So we have got those 3 players. Now on HVDC itself, I want a few details. Your order book is 7,300 crores. Any part of that is HVDC?
Yeah, part of that, we are executing one project for Mumbai HVDC, around less than 2,000 crores is part of that.
Okay, so 2,000 crores out of the current 7,200 crores is HVDC. I'm focusing on this less than 2,000 crores. I'm focusing on HVDC because that's where your core strength is. And as you told us as well, there could be a higher number of orders coming in from HVDC in comparison to what we have seen in the past, which is where the opportunity comes for you. Now, we're looking at a couple of brokerage notes, and they are factoring in 1 HVDC order per year that amounts to around 4,000 to 4,500 crores for the next 2 years. Is that a fair estimate? Novama is the brokerage note that is written, by the way, on that. Is that a fair estimate? One order you could win in the next year, 25 and 26?
What I'm saying is that, I also exactly told in the same channel that previously India used to have a one HVDC project for every 4 to 5 years.
Yes.
So from there, the market has moved to have at least one HVDC project per year. So that's the market available in that. So from one HVDC per year, our forecast is that in the next 2 to 3 years, the need to have at least 2 HVDC projects per year in that. So as you know, that HVDC technology invented by us 70 years back, and today 50% of the existing HVDC links in India, they run through our technology, and this is also the same globally in there. So we have a very strong value propositions and also the supply chains, and on top of that, the HVDC is a very niche technology, is a very high, technology intensive technology. Today we have built the capabilities to execute end to end in India in that. So that's
Mr. Venu, we are aware of all that, sir. We are aware of most of that, and we get your justification. But I need to get this out of you. One HVDC order per year is what you could win. Is that is that a probability? It may or may not happen, but is that the target that you'll have?
The market is available, and we will definitely look forward to that.
Okay. Sir, I just had 2 quick questions on the export side of things as well. Earlier, you had guided for, exports being 25% of your revenues. Can you tell us any plans to ramp up your export share, and what is the kind of visibility that you have in terms of export orders? We know that they've already gone up 43% year on year, but going forward, what is the visibility?
Right. So it has gone up for 43% on year, but if you really look at the entire FY23, our exports is roughly slightly less than 30% of the total orders in that. So we will be, anywhere between 25 to 30% ballpark figures, and that's where we would like to sustain from 25 to 30% exports.
Okay, and what is the opportunity? I mean, this global transmission equipment space has been rising quite a bit. What is the global opportunity size, and how much, of that pie can you enjoy?
Yeah, the tailwinds of the energy transition is huge across the global, especially in the North America, Europe, and some of the Middle East and South Asian countries. And I also talked about our clear strategy on the exports. We have a 3-pronged strategy. In some of them we have a global feeder factories. Those products we only manufacture here and we supply across the thing. We have five of those products in our portfolio in India. And the second one is, we have allocated markets, and that's where we have been working along with the local, sales and marketing to ensure that, we develop those markets and then supply our entire portfolio. And the third one is, we supply components to across our factories around the world. And this is where, we are ramping up some of the factories. And also we are expanding, as I told you that, we continue to expand since COVID time, and we are also expanding further on enhancing our capacities on the transformer and HVDC, etc.
Yeah. No, I mean, just to take off on that point, Mr. Venu, apart from transformers, in which other equipment or products can, Hitachi India gain market share in the parent's global supply chain? If you can give us a sense. So
I think there are a lot of areas where we are looking at it. One is that HVDC, for example, the components of HVDC to supply HVDC components, like a valves, for example. So we set up our factory here. So we are looking these things not only for the Indian market, but also for the global opportunities. That's one aspect. Then we are also looking at the STATCOMs, for example, is another opportunity. So these are...
Sorry, what was that? What was that? Sorry, I missed that.
STATCOM, these are power quality solutions.
Okay.
It's called as a STATCOM. So that's also quite a big opportunity is as part of our 500 gigawatt of interstate transmission. There's a lot many the STATCOM projects are part of those things. So that's also where we are a very big player in that market.
Okay, and that is already part of what you said is your addressable market in that 2.5 lakh crores. It's already it's kind of accounted for that. All right.
Yes,
fair enough. We'll leave it there. Great conversation as always. Thank you very much, sir. And appreciate your time here on CNBC-TV18. Hope to speak with you soon again. This is a sector which is booming. And of course, Hitachi is right up there in terms of what it's been able to do, gaining share. And the market, of course, absolutely rewarding this one. We'll take a break. We're back. Manisha will be joining in with all things commodities. And the market, I mean, at the index level, nothing at all. 5 points on the Nifty. That's the change. We're back.
All right, if you're wondering what's happening with the market, nothing much really. It's very, very quiet right now. But the good part is we're hanging on to the levels of 22,500 and the Sensex is up about 100 odd points. But let's do one thing. Let's get you a quick update on what's happening in the world of commodities. Manisha Gupta is here with us. Manisha, over to you.
Well, thank you for that. After copper, it really is about aluminum, where the prices have surged by nearly 3.5% in the overnight markets. We did see a two-year highs at $2,760 a ton there. But from those kind of levels, there's a bit of a profit-taking in Asia happening right now. So 27.10 or thereabouts is where aluminum prices on LME trading at. But the prices have seen nearly 6% of gains in the last 1 week itself. And the support comes in from the supply concerns for this one as well. There are statements from Rio Tinto which says that they are declaring force majeure on alumina cargoes from Australia refineries. Now, this is happening because there are power outages there and there are concerns about supply from there is the reason we've seen Rio Tinto do that. But it's not just Rio Tinto. When you look at Yunnan in China, there are smelter production cuts there as well because of drought situations, and that has led to supply moving forward from the markets there. It also is about the US and UK putting bans or sanctions on Russian aluminum. So the markets do believe that there are various factors enough to continue to support prices from here on as well. If you look at the manufacturing data that has come in from US and Europe, that has been on the positive side. Same is the case with China as well. China also is looking at its bauxite security from New Papua Guinea, and that is a concern from those markets there. It also has to do with Japan, which is buying aluminum at a premium right now for its 1 and 2 forward months, and that in turn has been supportive. If you look at the latest Citi report that has come in, it says that they are bullish on aluminum for the medium term, especially for the next 18 to 24 months. They believe that the aluminum prices have a lot of steam left in that one. They're looking at prices of around $2,800 to $2,900 a ton on the higher side. We're almost trading at 27.5 on the screens there. If you look at Indian markets, well, we are the second largest aluminum producers, third largest consumers as well. So when you talk about the demand herein, that has been on the higher side. The higher focus on EVs, automobiles, etc. has been positive for aluminum demand within India. When you look at the overall production, well, India is second, but really down south there. China produces almost around 82 million tons of aluminum. That was the number in 2023. But when you look at the India numbers there, we stand at around 7.3 million tons. So we really are the fourth one right now in the market there. When it comes to per capita consumption as well, here as well, the Indian numbers are quite on the far side. The world average is 12 kgs per capita per annum. China stands at around 31.7, while India stands at around 4.5. So the market believes that India production and consumption numbers could be going higher as far as aluminum is concerned.
Okay, thanks a lot for that. Well, let's talk about some stocks now. We have Sonal joining in to talk about Gulf Oil and GSFC. Sonal, over to you.
Well, let me start with Gulf Oil because it was a strong set by the company this time around. Revenue growth of 10% in Q4, EBITDA was up 32%, margins expanded by 200 basis points, leading to a profit growth of 40%. Even FY24 ended on a strong note. Revenues up 9.5%, EBITDA up 22%, and profits are up 33% to come in at 308 crore rupees. The company says they've been able to maintain the growth momentum in the year, with volume growth coming in at 2 times that of the industry level, and this was led by double-digit growth in the infra segment, mining and B2B segments as well. Growth was strong across all the segments except for OEM factory fill in the last quarter. So that is where some pressure came in for the company. For GSFC, the numbers are very weak because of the change in subsidy rates that impacted fertilizer sales for the company this time. Revenues down 17.5%, EBITDA down 94%, margins are just at 1%, profits down 89%. The caprolactam benzene spreads, that is the main product or the spread to look at for this company, that also declined on a YOY basis, though sequentially it has seen a recovery. But yes, weak set coming in from GSFC.
All right, Sonal, thanks very much for that. So that's GSFC in focus. Paytm reported numbers as markets were opening this morning. Let's put that in perspective. Abhishek is here with that. Abhishek, morning.
Morning, Prashant. So to begin with, Paytm has given its Q4 FY24 numbers, and the net loss is higher than street or analyst expectations. The revenues are down 2.7% YOY and about 20% sequentially. The operating expenses are up 8.7% YOY, but they have declined more than 16% quarter on quarter. So calculation shows that EBITDA has widened on a sequential basis. So my calculation shows EBITDA loss of 92 crore versus 11 crore that they had in the previous quarter. Operational Additionally, they have reported a loss of 293 crores, which has widened YOY and quarter-on-quarter as well. There is an exceptional item of 227 crores provisions that have been made for their impaired subsidiary, and net loss has widened to 550.5 crore when compared to 167.5 crore in the same quarter last year and about 222 crore in the previous quarter, and it is higher than Motilal Oswal expectations of 470 crore of net loss. They have given out some details. They say that they'll focus on distribution-only credit disbursals model. Collections under this model will be directly by lending partners as well. Full financial impact of prudent operation risk policies and temporary disruptions will be seen in Q1 of FY25. So they are confident to see meaningful improvement starting Q2 FY25. They expect EBITDA before ESOP a loss of about 500 to 600 crore in Q1 FY25 and improvement thereafter. Back to you.
Thanks a lot for that, Abhishek. Well, let's wind this down with Ekta. She's joining to tell us about Metropolis. Ekta?
Well, yes, I'll just concentrate on a couple of conference call takeaways. They're looking at mid-teen growth in FY25, volume growth of 8 to 9% and 5 to 6% growth from realizations. They believe that they would be able to sustain Q4 margins. Margins will be aided by revenue growth. They estimate margins to be between 25.5 to 26%, and they are going to be adding 25 labs. That will probably result in a 1% lab-related dilution, which they factored into their guidance. Net cash surplus, 117 odd crores. They won't look at debt, which would be beyond 2.5 times EBITDA. The acquisition will be funded if they do any via internal accruals, debt, equity. And strategies for M&A include looking at geographical presence such as North, East, South and West, as well as technical capabilities, regional players in the country. They're seeing B2B volumes rise and rationalization of discounting taking place at this point also.
Okay, thanks a lot for that. Let's slip into a quick break. On the other side, we'll be joined by the management of Greenply Industries to discuss their Q4 earnings and the outlook for FY25. Stay tuned.
Welcome back. Well, I think the stock you should be focusing on is BEL. Upasana sent us some of the con call details, and that explains why the stock has seen a big recovery from the low point of the day. They're targeting double-digit revenue growth of around 15%. They're talking about margins of 23 to 25% in this year itself, and they're expecting another export order of more than $200 million. That's the reason that the stock was down close to around 4% earlier in the morning. That's seen a big recovery as we speak, and some of those lines are flashing for you on the bottom of your screen. So keep an eye out on that. Upasana is listening in and in fact giving us more details on that front. Big recovery from the day's low. But as promised, let's get chatting with the management of Greenply Industries. The performance was rather mixed or relatively good. They have commenced their MDF operations as well. Well, to find out about what's the outlook from here on, Mr. Manoj Tulsian, the joint MD and CEO of the company, joins us on the show. Hi, sir. Good morning, and thanks a lot for joining in. Well, I want to focus on the MDF part of the business itself. What can you guide for on this business in terms of volumes? I think last year you did around 125,000. For this year, what could it be on revenues as well as on the margin front? Please go ahead.
Hi, Nigel. First of all, good morning, and thank you for having me on the show. It's always a pleasure meeting you. In terms of MDF volume, this year we are targeting to touch anything beyond 200,000 CBM. And the subsequent year also, then we can build up almost a 20 to 25% volume growth on the same.
Okay. And margins on it, what will it be? Mid-teens?
So margins is only going to move up, because it was the first year of operations, and as we maintain that it takes some time to get the operating efficiencies. So if you really see on a quarter basis, we are improving on our margins. I think for the full year, this fiscal, we should be in upward of 16%. And the year subsequent, we can further improve that by around 2 to 3% for sure.
Okay. Manoj, hi, good morning, and thank you for joining us. On the plywood business, what kind of growth are you hoping to see in FY25? What are the realizations looking like? Can you build on to them this year?
In terms of growth, last year also we maintained around, anything between 8 to 10% volume growth. We ended up somewhere around 8.6% as a volume growth. We don't have industry data to really understand that, how the plywood market is behaving. But I'm assuming for all the recognized players and the branded good players, there is a good market, good traction, going forward, and all the type of reform measures which is happening is only going to help players like us. So at this point of time, I maintain, anything between 8 to 10% as a volume growth. In terms of margin, for sure, I think, we have hit a rock bottom. Last full year, if you truly see, it was very difficult to pass on the raw material price increase to the market. But I think the market has more and more, with a time lag of 4 to 5 quarters, they have been able to absorb that. And we are strategically looking at, increasing or correcting prices in various markets. Coupled with that, I think, if we are also concentrating on improving our sales on the premium segment. If that also happens, then for sure the margins will improve.
So you're saying margins have hit a bottom in the plywood business and they'll improve going forward. So what are you looking at? By when do you think you can get back to double-digit margins? Will it be in this year itself, FY25?
I think, Sonia, this year I'm not very sure, whether it will go to double-digit. Yes, internally we are taking that as a target, but it's too early to say. But for the next year, for sure, I feel, 10% margin plus is something in this business is doable and sustainable also. So, and we will only be inching up. Also, what happened is last 1 year, if you really see, we increased our ad expenses. It has almost gone up on the same period basis by 1.1%. So that is something also which will slightly taper down, not my absolute investment. But now that I have a new line of business, there will be some amount of ad expense apportioned over MDF also. So my overall ad spend will not come down, but maybe as a percentage, I may get around 0.5% of benefit there also.
Okay. And ad spends is roughly now it's around 3.5% of your total sales?
True. Yes.
3.5%. You're saying it will continue to get maintained at these levels, right?
Well, yes, 3 to 4%, Nigel, is the type of investment what we look at, because it's a brand and we have been doing extension, like we added MDF. Now we are getting into hardware business. Maybe we'll add more line of business. So 3 to 4% of sales is something which we will continue to do as a brand investment.
Okay, give us a few more details, besides the operational performance. What is the debt reduction plan that you have in this year? As of the last year, I think it was around 500 crores. So clarify on that. And what about the working capital days? Where does it stabilize it? It's been in this vicinity of around 35 to 45 days.
So on the debt side, Nigel, if you really look at last year, we also had our Africa facility, which along with my India business resulted into a total debt of close to around 725 to 750 crores. And, in the last quarter, we have been able to hive off 51% of that to new set of investors. By virtue of that, we have been able to get rid of that portion of the debt. So the debt on a steady state for the Indian business, including MDF at the console level, is now close to around 500 crores. Given that we have capex investment of 70 to 80 crores during this year also, I am assuming that this 500 crores will reduce by 10% by the year end. It should come down to 450. That gives us a very healthy debt equity of close to around 0.55, from our existing 0.7. And going forward also incrementally, I think, we will see improving trend of reduction in debt.
Okay, one final question. So 10% reduction in debt, got that. One final question. Working capital days are currently around 47. Any plans to reduce it?
It can come down by maybe 2 to 3 days at best, because in the month of March, we had done some incremental, investment on the raw material side. In terms of the receivable cycle and this, we are already on it, so we don't see much improvement happening there. It can primarily happen on the inventory side, and maybe it can improve by 2 to 3 days for the full year.
Okay, all right, Mr. Tulsian, always good speaking to you. Thank you so much for joining us and speaking to CNBC TV 18. With that, it's a wrap on Bazaar. Chartbusters coming up next. Stay tuned.
Apollo Tyres gains after 2.25